Imagine you bought a stock at $100. It drops to $60. Every rational bone in your body says, cut the loss, but you hold. Then it drops to $40. You still hold. Not because you have new information, not because the company got better, but because selling feels like admitting you were wrong. That feeling right there, that is not a market problem. That is a you problem. And here's the wild part. Every single investor on earth has that same wiring. Billionaires, fund managers, your neighbor who brags about his crypto gains, all of them. Today we are going to break down the hidden psychological traps that silently destroy investment returns, and more importantly, how to fight back. There's a concept called loss aversion, and it was discovered by two psychologists, Daniel Kahneman and Amos Tversky. Their research showed something shocking. The pain of losing $100 feels roughly twice as powerful as the pleasure of gaining $100. Think about that for a second. Your brain is literally wired to fear losses more than it loves wins. So when your portfolio drops, your emotional brain hijacks your rational brain. You freeze. You hold losers too long. You sell winners too early just to lock in that good feeling. This is why most beginner investors underperform even basic index funds. It is not about intelligence, it is about emotion. And emotion has a very predictable playbook. Let me tell you about confirmation bias. You hear about a company, say a new EV startup, and something about it excites you, so you research it. But here's what actually happens during that research. You unconsciously collect evidence that supports buying it, and you quietly dismiss anything that contradicts it. You read the bullish analyst report twice. You skim the bearish one. This is confirmation bias, and it feels like doing homework. It feels responsible. But it is just your brain building a case for what it already wants to do. The real danger is that it gives you false confidence. And false confidence in investing is not just useless, it is actually dangerous. Here is where it gets really interesting. And this is the open loop I want you to hold in your mind. We are going to get to the one bias that is hardest to spot, the one that even experienced investors almost never catch in themselves. But first, the herd. Herd mentality is when you make financial decisions because everyone else seems to be making them. Remember 2021 when everyone and their cousin was buying meme stocks, or crypto in late 2017, or real estate in 2006? Each time, people were not analyzing fundamentals. They were watching others win and feeling left out. FOMO, fear of missing out, is one of the most expensive emotions a person can carry into a brokerage account. Now, let us talk about overconfidence bias. And this one stings because it hits people who actually do their research. Studies show that after a string of winning trades, investors dramatically overestimate their own skill. They start attributing gains to genius when much of it was just a good market environment. They increase position sizes. They trade more frequently. And then the market turns. And those same habits that felt like strategy suddenly reveal themselves as recklessness. There is a famous study where 80% of drivers rated themselves above average. The same thing happens with investors. Most people believe they are better than average. They cannot all be right. Okay, here's the one. The bias almost nobody talks about. It is called anchoring. And here's how it shows up in investing. You buy a stock at $200. It falls to $120. Someone asks you if it is a good buy at $120. Without realizing it, your brain uses $200 as the reference point. You think of it as cheap because of where it was, not because of what the business is actually worth today. That original price tag becomes a mental anchor that distorts every decision you make afterward. Anchoring also makes people hold through earnings disasters because they are still picturing that original price as the real value. The market does not care what you paid, not even a little. All of these biases share something in common. They are all shortcuts. The human brain evolved to make fast decisions with limited information because that kept us alive on the savannah. But financial markets are not the savannah. Speed and gut instinct will get you killed here. So what actually works? The answer is building a system that removes you from as many real-time emotional decisions as possible. Index fund investing, dollar cost averaging, automatic contributions, these are not just financial strategies, they are psychological armor. When you automate the decision, you remove the moment where emotion can sneak in. Warren Buffett has said that the stock market is a device for transferring money from the impatient to the patient. One of the most underrated tools in investing psychology is keeping an investment journal. Not a trading log, an investment journal. Before you buy or sell anything, you write down why. What is the thesis? What would have to be true for this to work? What would prove me wrong? Then when you revisit it later, you are not relying on memory, which is notoriously self-serving. Memory rewrites the past to make us look smarter than we were. The journal does not lie. It shows you exactly which biases showed up, how often you acted on emotion, and where your actual edge is, if you even have one. That kind of honest self-audit is what separates investors who improve from investors who just repeat the same expensive mistakes. Here is the reframe that ties everything together. Most people treat investing like a performance, something to win at, something to be right about. But the investors who build real wealth treat it like a process, something to follow consistently, even when it is boring, especially when it is boring. The psychological edge is not about being smarter than the market. It is about being more disciplined than your past self. Every time you do not panic sell during a crash, you win. Every time you do not chase a meme stock at the top, you win. These are not glamorous victories. They will not get you likes on social media. But they compound, quietly, slowly, exactly the way real wealth is actually built. You now know more about investor psychology than most people who have been in the market for years. Loss aversion, confirmation bias, herd mentality, overconfidence, anchoring. These are not abstract concepts. They are live wires sitting inside your brain right now, ready to cost you money the next time volatility hits. The fact that you understand them puts you ahead. If this video made something click for you, share it with someone who is just starting out. They will thank you later. And if you want to go deeper on building the kind of mindset that actually survives long-term in markets, there's a lot more where this came from. The best investment you will ever make is understanding yourself. Start there.